Thanks, thanks everyone for joining us. We're glad you're here. It's about 9:58. We have a lot of great information to share with you today, and we're going to get started in just a few minutes. So we'll give a couple minutes for people to show up and arrive. Like I said, to say 2020 has been filled with challenges would be an understatement. Here out of Merced in Central California, and just this past week, we had parts of California reaching 130 degrees. I think that's literally a world record. We've never had that heat before recorded. And this morning I woke up, and some of the things that are in the news are, the fires that are burning across California. And so, I went to Starbucks. I wasn't even really aware, the extent of the fires. This is, something that you could definitely, when you go outside, this is what it looked like this morning. It's a little hard to see, but the white dots on the table are ash that was falling from the sky. So it kind of, it almost felt like you were in the snow. The sun's red, the sky is filled with smoke, and that's just what's happening this week. So obviously a lot of challenges this year: coronavirus, shelter in place, the economy, unemployment. We have an election around the corner that is positioned to be very divisive. There's the postal service, everything that's going on there. And the list goes on and on, right? Those are just some of the challenges that we're up against. And so, when challenges like this start to stack up, they can build pressure. And so I wanted to share with you one of the, quote from one of my favorite people, John Wooden. All that matters is the pressure that you put on yourself. External pressures cause people to choke. While you can't control what happens to you, you can control how you react. And so that's why we're here today. We're here to help you react to all of the different challenges that we're facing from a real estate standpoint. And so we're right at the top of the hour. It's 10 o'clock. We're going to go ahead and get started. So thank you to everybody who is here on the call. Do us a favor. This is an interactive presentation. So if you could drop a note in the chat box, let us know where you're from. We're also going to be doing a Q&A session later in the presentation. So if any questions come to mind, whether you have some now or something comes to mind as we're getting into the information, type a Q, capital Q, and then drop your question in the chat box. We're going to be scanning for those Qs to make sure that we can help answer any questions that come to mind. And so, again, thanks for coming today. We put these calls on the third Wednesday of every month. This coaching call is presented by the Merced County Association of Realtors Commercial Real Estate Committee. Our focus is to equip people with the tools and information they need to win at real estate. And I'm excited to welcome our special guest today, Dr. Lawrence Souza, who's going to be covering real estate exit and alternative strategies. Dr. Souza holds the prestigious designation of being a certified commercial investment member, or CCIM, and currently serves as the Vice President for Research and Analytics for GreenSpark. Past experiences really are too numerous to list. I was on a call with Helen Chong last week, and she was talking a little bit about Dr. Lawrence Souza and his qualifications, and was a little overwhelmed with just making sure she covered all the information. I feel the same way. But Dr. Souza brings a ton of knowledge to the table. Past experiences include real estate, financial, and investment economist for Pillar 6 Advisors, Johnson Souza Group Incorporated, CapitalBrain.co, and the list goes on and on. And so some of the things that we're going to be covering today are how to exit in a timely manner, how to minimize tax exposure, how to maintain and improve income streams. We talked about some of the challenges that 2020 has brought. These are definitely challenges that you face if you're selling real estate. So if you own real estate, if you put deals together from a brokerage lending standpoint, or whatever industry you're from, we're glad you're here today. And with that, Dr. Souza, the floor is yours.
Great, thank you. Can you hear me?
We can hear you. Yep.
Okay, perfect. And then can you share my screen? Or I just want to make sure I can.
All right, so you should be able to share now.
Okay, can you see that?
Yep, we can see it.
Okay. I kind of look at real estate investment like big wave surfing. You got to be really smart. You got to be fit. You got to be able to anticipate when the big waves are coming. And if you do all of those things, you could actually catch these things, ride them in, and then paddle back out and do it again. You are going to get taken out by some of the big waves, and we're in one right now. We were one in 08, 09. We were one in 2001 through 3, in 91 through 3, in the early mid-80s, the early 70s. I mean, the business cycle and the real estate cycle has been happening for 150 years, and definitely post-World War II. The question is, do you see it? Are you going to get caught inside and taken out? Or are you going to be one of those surfers that are going to be able to ride these things and go do it again? I like to think of it as in real estate investment, just like being a big wave surfer. What I'm going to do is I'm going to go over exit strategies. Now, I worked on this presentation. It took me about a year or two to actually put it together with help from one of my students. I've been thinking about it for years and years and years. Starting as an investment economist for multiple brokerage firms and investment management firms and pension fund advisors, doing brokerage, and then doing wealth management and investment management. So I tried to pull all of the disciplines together to come up with at least some ideas of how to exit, because you can accumulate wealth in real estate, but when that big wave comes through and you're caught inside, it's a pretty dangerous asset class, just as dangerous as stocks and bonds and other asset classes. So you got to be really, really smart. And the way that you navigate these things is to surround yourself with really good people, really good business, tax, trust, real estate, accountants, attorneys, advisors, people that you can trust, people that will look out for your best interest, people that will be your fiduciary and do the best, on your behalf. Oh, that's my cat. Zachary says hi. He wanted to come to the lecture today, but I told him he couldn't come. So Zachary says hi to everybody. I'm not giving, in this presentation, I'm not giving any legal advice. I'm not giving any investment advice. I'm not giving any tax advice, accounting advice. I'm not qualified. I am not a CPA. I'm not an attorney. I am an advisor. I have the credentials. I can advise, but it really depends on the suitability and your condition and your position and what you want to do and what's important to you. I can have those conversations with you. I can refer you to people if you need referrals to people, but I am not making any recommendations within this presentation. Okay. So you want to get out of real estate. What's really interesting is I'll do a little case study. I had a client about 5 years ago approach me, wanted to get out of real estate, out of his asset. He was sitting on about $25 million worth of real estate. It took me a year to put together and structure the transaction, both from the investment advisory side and from the brokerage side, and working with the tax attorneys and the attorneys and the accountants to basically put together an exit strategy from him to get him out of his real estate without tax consequences immediately, to set up the strategy for the exit within the trust, to replicate and replace the income that he would have lost on the transaction, to mitigate the taxes, and to be able to create a synthetic income stream by bringing in other tools, financial tools and instruments to basically replicate his cash flow, hedge off his market risk, hedge off his mortality risk, and to hedge off some of the tax risk and actually put him and his family in a really good position. They came back to us and said that we were offering too low of a price, which was like, I think we were offering like 25 million. They said the property is worth 30. That they would do a better job managing the property themselves. This was 2017. We could have got him out at the top of the market. That he came back to me about 3 weeks ago and said, I'm sitting on about 40-something% vacancy within my building. I can't lower the rents because of the rent control. I'm probably, even though I'm conservatively leveraged, I'm probably going to be bleeding costs, over the next 6 to 9 months, and I need an out. I need an exit. Can you help me? I said, yeah, I can help you, but the terms and the structure that we put together for you 3 years probably doesn't exist today. I will do the best I can to help you, but we really should have done the transaction 3 years ago at the top of the market. Just a little, example, of a real life situation. So you want out. Well, real estate assets are highly illiquid. It's not simple to just sell, the real estate just like you would shares of a stock. Exit from real estate investment can be extremely costly in terms of time, opportunity cost of funds that are locked up in the real estate. And then you have to look at the capital gains and the depreciation recapture tax, plus the transfer tax, plus the Obamacare tax. And if you want to talk about taxes, this article just came out, I think it was yesterday, that talked about the Biden tax plan. He wants to raise roughly almost $4 trillion over the next decade, which I don't think is enough money to pay for the current budget deficit and the $25 trillion that's currently outstanding on the balance sheet of the United States. It's going to come mainly from high-income earners, corporations, businesses, and I'm sure the real estate guys will be targeted too. They're saying that the richest Americans that make over $500,000 a year will probably be seeing their taxes go up 13 to 18%. And even people at the bottom of the socioeconomic and socio-demographic spectrum will probably be looking at least a 1% increase in the taxes. This is probably going to shave off about 1.5% in GDP. We've been growing at about, I don't know, in 2016, 17, 18, we were running about 3 to 4%. Since then, it's basically been 2. GDP was negative 9% last quarter, but on an annual basis, it was negative 30. So if we're looking at higher taxes, you're looking at lower economic growth or economic demand, which will affect real estate. Higher taxes will affect real estate from a multiplier effect. They're going to go after some of the larger corporations like Amazon, Google, some of these monopolies that have been paying, extremely low corporate income taxes, and they'll probably put into effect some type of billionaire tax too. It's just going to bring you up to speed. So the goal is to complete the exit process in a timely manner while minimizing tax exposure, maintaining or improving durability of income streams via effective use of exit strategies. Time. The key is when you get out of real estate, you got to expedite the closing process. Opportunity cost, you could be using the money during that time you're trying to close into other investments. And then you need to really look at your capital gains and your recapture tax. And maybe it's time to set up an irrevocable trust or some kind of trust structure to be able to minimize the taxes upon death. Death and taxes, as we know, are guaranteed, but the real question, and really the people that I've been working with over the years, they kind of fall into two groups. One is how can I benefit from this? And then the other is, how are my family going to benefit from this? They're two different types of individuals, but the people who are really focused on wealth transfer and wealth generation for the kids and their grandkids, those are usually the people I like to work with the best. So to proper exit this, you need to increase the project viability and reduce your costs. So here are your basic exit strategies. There could be some others in here. Again, I'm not a tax attorney. I don't live and breathe taxes, but these seem to be the exit strategies that I came up with. And I have more detail, later in the presentation that I probably won't get to, because this is about a 3 to 6 hour presentation, depending on who I'm talking to. And it's usually people in their 20s in my real estate classes. The first thing you can do is do a cash out refi if you're conservatively leveraged enough. And if you're going into a downturn and your NOI and your economic occupancy are going to fall, you want to make sure that you have enough economic occupancy and debt coverage to be able to cover the cash out refi. You can pull the money out. There's no taxes, but you got to be able to cover the mortgage. The carryback note upon the sale, that's another way to do it. If you're selling your property, you can carry back the note. Use that as an income stream. Again, you're taking some credit default risk based on the credit worthiness of the buyer to be able to service the note. You will have to pay income taxes on the income stream that comes in, but it is a way of staying in the deal, but getting out of the deal and creating a cash flow. The installment sale, this is basically where you're selling the property in an installment contract. You're basically spreading out the capital gains and the recapture tax over the installment period embedded in the installment contract. And actually the installment contract comes in extremely valuable when you're doing a deferred sales trust, which is basically the addendum to the 1031 exchange if your 1031 exchanges and you can't close within 180 days. So it's a fallback position. So you're doing the 1031 exchange, you identified the 3 replacement properties. It looks like the 3 properties are not going to go. You're totally screwed. So what you've already done is you already put an installment sale into a deferred sales trust, and on the time when your property does sell, it's already in the trust that basically it sells within the trust, and then the installment sales contract basically takes hold. And as you start to take the proceeds from the sale, you're going to be paying your income taxes and your recapture tax. You can 1031 exchange into TICs or tenant in commons. There's 2 types of TICs. There's the ones that you think about in San Francisco, and then there was a whole slew of syndicators that were doing TICs in the early to mid 2000s, around no, actually 2006, 2005, 2004. The famous one was DBSI. Those guys were really aggressive. They were out there syndicating these tick deals, getting 1031 money into these syndicated transactions. Turns out that they were charging really high fees. They were cooking the books. The properties were over leveraged. And when DBSI blew up, it took out the TIC market as a vehicle as an alternative exit to the 1031 exchange. A vehicle now, and actually you have to be a registered rep buying through a broker dealer to get to the TIC. I don't even know if they're still around, but the replacement product is the Delaware Statutory Trust, also called the DST, which could be confusing. These things have been really popular over the last 3 to 5 years because you can 1031 exchange into these. It's a better structure from a real estate standpoint because you can get mortgage finance on it. You couldn't really get mortgage finance from the banks on the TICs. So the DSTs, or the Delaware Statutory Trusts, have been very popular, although that market's been disrupted currently because of the capital market disruption and because of the disruption to the real estate market. But it's something to look at if you want a passive approach, to investing in real estate as an alternative to the triple net leased product. Triple net leased strategies are going to be recommended and executed by your real estate broker. I like to actually combine real estate investment strategy with investment strategy along with tax and trust strategy to optimize the solution. You could also 1031 exchange under the IRS code into oil, gas, leasehold interests. Those are very popular in the South, West, and East, particularly in Texas. In the South, these are kind of like a roach motel. You can get into these things, but they're really hard to get out or roll over. I really haven't seen much to this stuff, but it is, on the books as a place that you can 1031 exchange. And again, you got to do your due diligence and underwrite your sponsor and underwrite the transaction and underwrite the structure, of the exit when you do these things. And that's where your accountant and your attorney will come in, and your investment advisor will come in, will be extremely valuable. Another one was the private annuity trust, or the PAT. That was taken off the table in 2006. That was actually brought in I think 1913 by a bunch of rich families on the East Coast, basically lobbied Congress to structure this deal. And it was actually very popular in the early 2000s. What you could do is you could throw all your real estate into the private annuity trust, sell it without any capital gains or recapture tax, reinvest all of the proceeds, so that was generating, let's say 10%, annualized returns. The IRS would say, well, you need to pay out 8%, and that's where they're going to get your capital gains and your recapture tax. But just as long as you had a spread between what you were earning and what you were paying out, the assets would accumulate in the PAT to the point that upon death, within 30, 40 years, you've probably doubled, tripled, maybe even quadrupled the assets that would then go to your heirs at a stepped up basis. And you could have actually even borrowed on the assets within the trust and pulled some money out, almost like a cash out refi. Amazing structure. IRS took that off because they were losing too much tax revenues. Opportunity zones now are becoming a little bit more popular. I think it's an untested exit strategy. It hasn't been around a long time. I know Cantor Fitzgerald out in New York has been pushing those, on a national basis to investors. I just don't see the track record yet, but you get bipartisan support from, both parties around the opportunity zones. I don't know. I would take a look at it, but again, you need to probably have your broker, your accountant, and your attorney, help underwrite these things. There's also what is called the monetized or the coupled installment sale. This is not known by a lot of people because it has been around for a long time, but it hasn't been used. There has been some IRS letters on it. There's a couple people out there that are very intimate with these things. Basically, what you're doing is you're working with an accommodator, working with a bank, which, those two institutions work closely together. And basically what you're doing is you're taking your assets, pledging them, you're getting a loan from the bank, you're taking the proceeds, in the accommodator, and you're investing in some investments. You're basically tying the return on the assets to the loan payment. So you're coupling it and monetizing it and matching it. And then the proceeds are basically a tax-free loan that the IRS is willing to give you for 30 years. And at the end of the 30 years, you will get a tax bill from the IRS saying, pay us the money. But you got to use the money for 30 years tax-free. I think if you do it right and you structure it right, and you have good investments and good managers to manage the money, you'll probably come out ahead. And if you're young enough and insurable, if you slap some permanent life insurance, on it and project out based on some type of mortality table, your time of death, you could have a insurance policy where the death benefit would pay off the taxes, and everything else would be left to your heirs, through some type of trust structures. Again, these things are extremely complex, but again, just something to think about. A lot of us like to accumulate real estate assets. If you're lucky, you can do syndications with others, or if you're of a certain means, you can start to accumulate a portfolio of assets. And if the portfolio of assets reaches a certain quality level that are appealing to real estate investment trusts, you could do a down REIT structure and exchange the properties for OP units or operating units within the REIT. You'll have to, it's like an installment thing. You'll have to exercise the options and the shares or the grants over a period of time. A lot of people will put that stuff into a trust to tax defer the gains. So that's one way, but the quality of the asset has to meet the criteria, underwriting criteria, and acquisition criteria of the REIT. And which you could do if you're of means, which a lot of developers did in the 90s, is they were sitting on a bunch of developed properties, institutional grade that they were sitting on. So they went from developers to asset managers. And then they worked with the management consulting firms and the investment banks, repositioned, reorged their corporations to become modern real estate investment trusts, and did an UPREIT structure, and basically took their companies public and basically positioned themselves for potential buyouts, from an M&A with other real estate investment trusts. There's other ways of exposing to real estate. If you want to stay, exposed to the real estate, you can invest in Reg D filings. You have to be accredited and qualified to participate in the private equity market at certain unit sizes. You can go to a company called capitalbrain.co if you want to register and take a look at some deals. But again, you got to be accredited to be able to participate in the private equity side of the market, and there's no 1031 exchange benefits to that. You could always buy shares in private REITs, public REITs. You could buy REIT bonds and REIT preferred stock. You could buy REIT bond and stock ETFs. You can buy REIT mutual funds, both open and closed funds. That's another way to participate. Those are, except for the private REITs, those are highly liquid vehicles. You could do public-private debt funds, both open and closed end, that invest in commercial mortgage-backed securities or residential mortgage-backed securities. So you got the real estate as the collateral, but you basically have the priority, as the debt holder, from the income streams. And those are tranched out to and rated by the rating agencies. You can do direct investment in first and second mortgages if you want to play in that realm, and in pools. You could be a general partner and raise money from limited partners, and be the managing partner and get fees and basically manage assets that way and build out your real estate services company. You can do syndications where you're partnering with other people on individual assets or portfolios. And over the last 10 years, I would say we started to see, before this crisis, some interest in crowdfunding platforms, both debt and equity. And actually some of the private equity real estate guys were establishing crowdfunding verticals within their private equity firms to be able to leverage their equity. You got to be accredited to play in that crowdfunding platforms. I'm not really sure where the development is of that capital market right now. Again, it was pretty popular, but again, another vehicle. You could invest in, if you're an institutional investor, you could invest in commingled funds or single accounts with pension fund advisors. Is another vehicle, but those are really institutional accounts. And then in the, I would say up until about 2009, there was a development of real estate property derivatives, which there would have been property derivative products that would have been created off the derivatives. Those things blew up in the financial crisis of 09, 08, and those things aren't, available today. And then another way to exit real estate and diversify into real estate. How much time do I have left?
We're just at 10:30.
So how much time do I have?
About 10 minutes.
Okay, perfect. So I'll finish it. The other way to diversify or exit real estate is basically to take the cash flows that are coming off of the piece of real estate through obviously your pass-through LLC that's being used. Or you could, as you accumulate assets, you could set up an asset management company and take X percent of the gross potential rental income off the top into the corporation. You can pay yourself a salary, a bonus. You could deduct all of your medical expenses. You can set up a defined contribution program. You could set up a defined benefit program. You could hire your kids and pay for their college if they study business and not sociology. You could have a C Corp where you're granting options to employees to incentivize them. That's kind of another layer to diversify your real estate holdings. And if you set it up correctly, you might even be able to manage other people's assets and start your own fund and become a family office at some point. But a way to diversify out of real estate is to take the cash flows and not to accumulate them to go into more real estate, but to diversify into the financial markets. So, looking at, convertible life insurance to hedge off your mortality risk, but be able to convert it into permanent cash value life insurance and accumulate cash value. And the cash value you can borrow back tax-free. If you're backed by your insurance policy is backed by a AAA rated mutual insurance company, which I think is a great vehicle. If you want to track the market within your insurance vehicle, you could use a variable universal life that's backed by mutual funds. The cost structures are a lot higher there. You really got to fund these things. But again, it's just another vehicle, with your after-tax money that you can fund. Long-term care insurance, as a principal of your own C Corp, you and your wife can deduct the premiums on the long-term care. That market's been completely restructured. You can't get unlimited life anymore. I think most of the terms are limited to 10 years. And you can even do lump sum long-term care, which is a hybrid between universal life and long-term care. You gotta be underwritten for both the long-term care and the insurance. So that's why you want to do this stuff when you're young and healthy. All of my students are going, "Oh, Professor Souza, I'm young and healthy. I don't have any kids. I don't need life insurance." It's like, what are you talking about? It's like your parents spent, $250,000 getting you here. And if you get hit by a bus tomorrow, they get nothing. Get $1 million worth of life insurance, so at least your family, has something to fall back on. But my students never listen to me. If you're going to be running your own business or a principal in your companies, they're going to need disability insurance on you, and you're going to need it. You're going to need umbrella insurance for your business because you're going to be a target. If you're making money through your business and or your real estate, people are going to be targeting you and they're going to sue you. So you're going to have some badass attorneys that can swoop in and take out the predators because once you become successful, you become a target. Same thing with property casualty insurance. You're going to need that. And you're going to need to insure it up to the point that you're comfortable to be able to self-insure. You got a $2 million property, you're only going to insure it for $1 million when the fire and the earthquake comes in. The insurance company is going to pay the $1 million, I hope, and you're going to have to come up with the other $1 million because you didn't cover, the total replacement cost of the property. So you're going to have to think about that too. So that's really your risk mitigation, your risk management strategies. Then there's the investment management strategy. So you got your 401k. You can roll it over into a self-directed IRA. Actually, Pensco out of San Francisco could set it up where you can invest in real estate, but everything's got to be segmented and separate. You can't commingle any of this stuff. You can invest on the qualified side or the pre-tax side, and businesses and real estate and stocks and bonds and mutual funds and that stuff. But you're naked, so you're going to be subjected to the cycles of the business cycle and the real estate cycle and the stock market and the credit cycle. You can, once you've rolled over your 401k into your IRA or you've contributed to a separate IRA, which allows your money to basically grow tax deferred, you can also roll some of those into a variable annuity with a guaranteed investment protection rider, which basically protects your principal. And what you do is you reset the basis. It's like a long put option. You're paying about 100 basis points on your AUM, for this put option. But it's a nice vehicle if you're worried about downturns in the market. It allows you to be able to protect your principal, and you can reset the basis 3 times over like a, I don't know, a 14, maybe 20-year period. You can also roll money into a guaranteed future income annuity that basically states if you put $1 million in, I'm 50, when I'm 70, I'll start taking, 100 grand a year, and I get 100 grand a year for the rest of my life. I can do it joint with my wife too. But that's a good vehicle too, that a lot of people, went into because after the 08-09 crisis, they saw a lot of their money evaporate in the stock market. And then when you turn 80, 90 years old or 100, you move into fixed annuities. And then the annuities are good too because they're asset protected. And then lastly, with your liquidity after tax, you get pushed into the non-qualified after tax realm. You can use your after-tax money to invest in businesses, real estate, stock brokerage accounts. Again, if you're going to be investing in those, you're probably going to be subjected to capital gains and real estate capital gains and recapture. You can invest as much money as you want into those variable annuities with the guaranteed investment protection riders. People love those things because there's no limit like there is on the pre-tax qualified side. Your money basically is accumulating tax deferred, it's asset protected, and then you're going to pay the taxes when you pull the money out in the future. Same thing with the guaranteed future income annuities. You can put money into those. And the IRS basically said that since you bought those things with after-tax money, 2/3 of the payouts from those are going to be tax-free. And again, you can put money into the fixed annuity side. The last caveat, and I think I'll be right on time, the last caveat is when you start to fund on the qualified side and the pre-tax side, if you need the money and you need to pull the money out at 59.5, you're going to pay the capital gains and a 10% penalty. At 70.5, the IRS is going to show up on your doorstep, and they're going to say, well, we've basically allowed you to defer your taxes over the years. Here's the formula. We're going to force you to start taking your money because we want our taxes. Okay, so I'm just going to end it there. And I should be right on time.
Hey, thank you. Yeah, a lot of great information. Questions are coming in. Jeffrey asked, is it possible to get a copy of the deck for review?
Maybe. I would have to interview the person. It took me 5 years to develop this thing. This is part of my intellectual property. I can't promise that I'll give it, but if the person is interested in talking to me, I'll talk to them and I'll make that decision.
That's great. So you can see on the screen now, there is Dr. Souza's contact information. Another question that just came in.
And again, I'll answer the questions of my capability, but if I start to, move into tax, trust, legal, those types of realms, I'll recuse myself from the question.
That's great. So you do your best to answer, but if you're unable to, that's okay too.
Thank you.
So question from Warren, any new updates with 1031 exchanges if we get a new party in the office?
Again, I'm not a tax attorney, but I tried to read to you what I read today. That just came out from Yahoo Finance on the, and I apologize, my camera's not working, on what some of the tax proposals that could be coming out, from the Biden side. Obviously, Trump wants, to make, income taxes for corporations and for, payroll taxes. He's going to try to push through some permanent tax cuts, before his tenure. I don't believe that he'll be able to do it. Although the Republicans do control the Senate and do control the executive branch. but I would not be surprised, and I did read something that Biden was looking at the 1031 exchange. I don't know if it's going to be tiered or if it's going to be progressive, what the tax structure, will look like, but he did mention it, that he would look at it.
Larry, what about Prop 13 for residential in California? Is that a sacred cow, or does that have a chance of being tinkered with?
Well, I think you're going to have to talk to the Howard Jarvis, people about that. I mean, they'll fight for that forever. Again, with the blowing out of the budgets, I mean, I think we're looking at like $23 billion in deficit at the state level, and I'm sure the local municipality budgets are going to be blown out too. So I think everything's basically on the table, and I think it'll be another bloody fight.
That's great. Question from Ernie that just came in. So lots of investors are leaving California and exchanging into other states. Where do you see the greatest reinvestment opportunities in other states? So what are some of the areas that people are looking at?
Yeah, everybody asked me that question. Again, I would want to talk to the individual. But again, I'll just give you some high level due diligence. The first question is, do you want to stay in the Western region? Okay. Or do you want to venture into Texas or the Midwest, the South or the Northeast? Every single geography, has its own risk return based on the economic base, the quality of the product. Obviously, you got to underwrite the tenant credit, risk. There may be higher cap rates, but that comes with higher risk, probably from the supply side, but also from the demand side. If I was going to do, an exit from California, and again, this was my criteria, before COVID, right? This was my criteria, but COVID's changed everything. I would have said, before COVID, you want to be close to, airports, intermodal trucking terminals, ports, hospitals, universities, all of these, resilient, counter-cyclical industries. Well, those counter-cyclical industries are some of the most hard-hit industries currently from the COVID. So you're going to have to, if you're going to be exchanging out of California, I would put together a checklist, of your underwriting criteria and try to score these deals to be able to assess, the level of risk and return that you're taking, and hopefully you're getting compensated with the return for the amount of risk that you're taking. So things have changed, significantly over the last 5 months in how to underwrite deals. Those industries probably will be resilient, but the real risk is nobody's underwritten a pandemic before. Nobody's ever underwritten healthcare, or education, or housing before. A lot of that stuff should have been underwritten at the policy level by the politicians. Well, they didn't do it. And now the pandemic has basically triggered systematic risk that becomes extremely difficult to underwrite, but you need to be compensated for that systematic risk. And each property sector, property type, geographic location, submarket, neighborhood have a different beta. They have different sensitivities to macroeconomic and microeconomic factors, and you're going to have to do your due diligence. I'm sorry, it wasn't more of a straightforward question, but that's the best I can do.
Real estate's definitely nuanced. Have you, taking all that into account, have you seen any patterns emerge from places people are going? Coming out of? Going to.
Going into, well, just anecdotally from, talking to a lot of my business partners and people that I interact with. The first is basically the emptying of the CBDs. The urban infill, the core, which has all of the, amenities, and the efficiency and the productivity of the workforce. now that everything is basically shut down and there's really no transparency in what the rate of absorption or reabsorption or reoccupancy, and the re-commercialization of the urban cores, a lot of the urban inhabitants have started to move out to, periphery, edge, suburban, submarkets, and even to, edge cities, within geographic regions for housing relief and for higher, standards of living and higher quality of life. So that's the one trend. I mean, New York lost about 500,000 people. Let's just say Manhattan lost 5% or 500,000 people over the last 5 months. If you use that 5% out-migration figure for San Francisco, you're looking at least 40,000 people have left San Francisco within just a few months. And we're coming up at the mid part of October. I'm sure people are starting to give their notices, and I wouldn't be surprised if you see a second or third wave, at the end of August and at the end of September. And they're moving east, and they're moving to higher quality of life, lower cost of living locations. And if you're in the tech sector and you can run your business virtually, you got it made. You're making your salary, you got your stock options, you can buy your house, you can basically buy 2 houses, based on the rent that you're paying in the city. I mean, it's basically a flight to quality, a flight to safety. And it'd been happening for decades. It's just now basically a wave. I don't know if that answered your question.
Yeah, that's great insight. You talked a little bit about the market we're in today, and with everything that's happening. Are there maybe a top 1 to 3 exit strategies that you're talking about with clients that you're helping?
At the current state right now, a lot of those exit strategies are put on hold because the markets have been disrupted.
Yeah.
You're looking at historically low interest rates, although the rates, have moved up, over the last couple of weeks, which has put some pressure on borrowers to rethink, although, rates are still at historical lows. So, the cash out refi, if you got the leverage and you got the occupancy and you're in a resilient market and a resilient property type and property sector with good tenants, could be an option. Again, the retail market has been disrupted, so the triple nets need to be underwritten carefully. The TICs are off the table. The Delaware statutory trust market has been disrupted because we're trying to figure out, what the impact on the collateral, is really like. The REIT market has taken a significant hit over the last 5 months, although it usually leads the market in bottoming and leads the market in the recovery. But that's not a real, exit strategy. I think the real exit strategy is, capital preservation, looking at your asset, figuring out what it is you're sitting on, asset managing, the best you can. And then, some of my clients are saying, I had a good run. I've owned it for 20, 30 years, see if you can put a deal together, for me. Let's try to mitigate the taxes as much as I can. Let's try to preserve the cash flow the best that we can. Let's try to get as much, money out as we can. And if, we can go into alternative investment vehicles, to provide durable cash flows, please, bring me the solution. But again, it takes a lot of time and a lot of effort to put these programs together. So I got to figure out, how I'm going to be compensated and what the probability of compensation is, because again, at the end of the day, we got to get paid.
Yeah, that makes sense. We have another question. In your opinion, is the stock market overinflated because of the new apps that make it easy for the common person to buy them?
No. The reason why the stock market is overinflated is because the federal government basically has run a $3 trillion deficit within 8 months. So they've injected massive amounts of liquidity, on the fiscal side into the marketplace. I'm not sure where a lot of that money went. They won't tell us, but I know it went somewhere. And my feeling is a lot of it went into the stock market, and the Federal Reserve's balance sheet increased from roughly 3.4 trillion to over 6 trillion right now. So there's another 3 trillion. So basically between the fiscal side and the monetary policy side, you're looking at about $6 trillion of liquidity injections into the marketplace. And that's, held up the real estate market, held up the banking institutions, held up the stock market. But my question is, if Mitch and Nancy, can't come together, on an agreement, and can't give these people $400 to $600 a month to keep the economy and keep them afloat, we're probably going to go back into another recession, which means they're probably going to have to come back with more stimulus bills, and the Fed's going to have to print more money, to keep this thing going. And the question is how long can you keep it going? At some point, the Republicans are already saying we're done. I don't want any more stimulus. People are desperate. They need that money. Walmart just came out with its, revenue projections and earning projections, and they're holding up fairly well. But some of the other retailers, their revenues have dropped like 20%. So you're already seeing the multiplier effect start to trickle through the retail market, and three quarters of the economy is on the consumption side, is on the retail side. So, I think it's, when are you going to cure COVID? You need some leadership on that. And two, how long is the Fed, going to print money to buy, our paper from the fiscal side, to run, perpetual budget deficits? At some point, you're going to, and we're already seeing it. You're seeing debt-fueled inflation right now, where there's so much stimulus in the marketplace, where actually, along with disruptions to the supply chain out of China, you're now seeing some inflation starting to flow through. Well, with unemployment rates at 10% and underemployment rates at 20% and labor participation rates as low as they are and contracting GDP, you're looking at basically a stagflationary environment, which is the worst scenario you could have from an economic and a policy standpoint.
And the stagflation, could you expand on what exactly is that? What's the scenario you're describing?
Yeah, the Federal Reserve targets and inflation, core inflation, stripping out, food and clothing and all those things that we consume the most. So they hold down the inflation rate target so that they can print more money. If you look at the CPI index, which is a flawed measure of inflation, right now it's about 1.2, maybe 2%. But you ask anybody in your audience what their inflation rate has been per year over the last 3, 5, maybe 10 years, they're going to probably say 8 to 10%. Because I'm consuming education, which is expensive, particularly college. I'm consuming healthcare, which is running about 10% increase per year. My food costs are going up 10% per year. My rents are going up at least 5% per year. So if you really look at the true inflation rate, it's significantly higher than is actually being reported. And then if you look at the labor market's been completely disrupted. And the longer the furloughed workers stay unemployed, they're going to become permanently unemployed. And then they're going to fall off of the unemployment rolls, and you're going to see a collapse in labor participation rate. And we're now at the lowest labor participation rate ever in post-World War history, which is a total labor policy disaster.
Mm. Wow, great information. Last question. A lot of the audience is made up of agents or independent contractors that are 1099. Do you are there strategies that you recommend from a liability or tax standpoint on 1039 agents setting up a LLC or S corp versus a sole proprietorship for taxes
Well,
and liability?
the sole proprietorship, is a problem, right? Because you have unlimited liability.
Mm-hmm.
So that's a problem. The LLC at least sets up a veil of protection, which makes it very hard to pierce. So that's a good cheap route to go. But again, I'm not recommending it. You'd have to talk to your tax and tax accountant or attorney about that. And then it really depends on what your cash flows are and where you're generating your revenue, what your liability structures are, and what your partnership structures are. If you're going to do an S corp, again, you got to really understand who it is you are and what you're doing and what you're going to do. And then you could always elect to be a C corp. It takes more time and effort. There's benefits associated with it, but you gotta manage it, you gotta administer it. It's another vehicle, another structure to look at. But again, you really have to understand your business and where you are and where you're going and who you want to be able to make those type of tactical and maybe even strategic decisions.
Great insight. Everything's nuanced, so everybody's situation is different. We're coming up at the top of the hour. Dr. Souza, could you put up your contact information one more time, just in case someone missed it? They know how to get a hold of you.
Sure. Can you see that?
We can see it. Yep.
Okay, cool. Thanks, Dan.
Well,
I appreciate it.
thank you so much for your time. I always feel like I learn so much whenever I hear you speak, and thank you for joining. We will definitely be sending out some follow-up information. I know some people talked about getting some additional information post call. So thanks again, everybody, for joining, and we will talk to you soon.
Thanks, Dan.
Thank you, Dr. Souza.
Yep, you're welcome.
See you
My
later.
pleasure.